There are moments in global markets when one decision, made quietly and far from public attention, changes the entire trajectory of an asset. No press conference, no dramatic announcement, just a shift in behavior, and then suddenly prices start moving in ways that don't make sense to most people watching from the outside. That is exactly what is happening right now in the silver market. China has changed how it interacts with silver, how it acquires it, and how it treats it strategically, and the consequences of that shift are already showing up in prices, inventories, and global supply chains. The move didn't make headlines, but it has fundamentally altered the balance of the silver market faster than almost anyone expected. What makes this moment so important is not just that China is buying silver. China has always consumed silver. What has changed is how, why, and at what scale. And once you understand that change, the recent movement in silver prices stops looking random and starts looking inevitable. To understand why prices are reacting so quickly, we need to start with China's position in the global economy. China is not just another industrial consumer, it is the world's largest manufacturer, one of the largest energy builders, a dominant force in electronics, solar technology, batteries, and infrastructure. When China changes how it sources a critical material, the entire global market feels it, even if the change happens quietly. Silver is one of those materials. For years, silver sat in an unusual position. It was treated like a precious metal by investors, but like an industrial input by manufacturers. That dual role kept prices contained. When investment demand rose, industrial demand softened. When industrial demand rose, investment demand faded. The balance held until China disrupted it. Over the past few years, China has dramatically expanded its use of silver across several sectors at the same time. Solar manufacturing has surged, electric vehicle production has accelerated, battery technology has advanced, grid infrastructure has expanded, semiconductor and electronics manufacturing has grown more complex and more silver-intensive. And unlike in the past, China is no longer relying on short-term market purchases to meet this demand. It is locking in supply. That shift alone is enough to change a market. When a country with China's scale moves from buying as needed to securing long-term physical supply, available silver disappears faster than price models predict. Spot prices don't immediately reflect it. Futures markets don't immediately reflect it. But physical availability tightens, and once that happens, price movement accelerates suddenly. That's why prices are moving faster than expected. But there's another layer here that makes this moment different from anything we've seen before. China is not just consuming silver, it is reducing how much silver it allows back into the open market. When silver is used in Chinese manufacturing, much of it is effectively removed from global circulation. It's embedded in solar panels, electronics, vehicles, infrastructure, products that are exported worldwide but do not return silver back into supply. This is critical. Silver is not like oil. It is not burned and replaced quickly. It is not recycled efficiently at scale. Once silver is used industrially, a significant portion is permanently lost to the market. So when China increases industrial use while simultaneously securing supply, the effect is cumulative. Less silver available, less silver traded, less silver recycled, and that creates pressure that no futures contract can relieve. This is why analysts tracking physical inventories, not paper prices, have been sounding alarms. Warehouse stocks are falling, refiners are facing tighter sourcing conditions, delivery times are stretching, premiums are rising quietly even when headline prices look calm, and now the market is beginning to react. But the most important part of China's move isn't just industrial demand, it's strategy. China has spent the last decade learning a painful lesson about resource vulnerability, trade tensions, sanctions, supply chain disruptions, energy shocks. All of them expose the risk of relying on open global markets for critical materials. As a result, China has shifted toward securing long-term access to strategic resources, not just silver, but copper, lithium, rare earths, and energy inputs. Silver is especially important because it sits at the intersection of energy, technology, and defense. Solar panels require silver. EVs require silver. Communications infrastructure requires silver. Military electronics require silver. Space and satellite systems require silver. China understands that future economic power depends on controlling access to materials that cannot be substituted easily, and silver has no real substitute. Copper cannot replace it. Aluminum cannot replace it. Synthetic alternatives cannot match its performance. So China is acting accordingly. What makes this even more disruptive is that China is doing this while global silver mine supply is stagnating. Ore grades are declining. New mines take years, often decades, to develop. Environmental and political constraints limit expansion. Energy costs raise production expenses. The supply side cannot respond quickly no matter how high prices go. This creates a dangerous mismatch, demand rising structurally, supply constrained structurally. That is the textbook definition of a real shortage. But markets don't reprice shortages instantly. They resist, they delay, they assume balance will return, and that is why silver prices were slow to move at first. But now something has changed. Prices are no longer reacting to speculation, they are reacting to availability. And this is where China's influence becomes impossible to ignore. As China absorbs more silver into long-term industrial use, the rest of the world is left competing for a shrinking pool of metal. Solar manufacturers outside China must secure supply. EV producers in Europe and the US must secure supply. Defense contractors must secure supply. Medical technology firms must secure supply. All of them are now bidding against a buyer with massive scale, long-term planning, and government backing. That shifts the pricing dynamic completely. Silver is no longer priced only at the margin by traders. It is increasingly priced by industrial urgency. And when urgency enters a market, prices move faster than expected. Another factor accelerating this move is the disconnect between paper and physical markets. For years, paper-silver trading created the illusion of abundance. Futures contracts could be rolled, positions could be netted out. Physical delivery was rare, but now industrial users are not interested in paper. They need real metal, delivered, refined, usable. That changes everything. When physical demand rises while paper supply remains high, the system stretches. When enough physical demand appears, paper prices lose control. Premiums rise, delivery constraints emerge, and eventually price discovery shifts from financial exchanges to real-world transactions. China's behavior accelerates this process. By removing physical silver from circulation and embedding it into long-life products, it reduces the buffer that once absorbed demand shocks. This is why price moves are happening faster than traditional models predicted. But the story doesn't stop at price. There is a broader implication here that few people are talking about. China has effectively signaled that silver is no longer just a commodity, it is a strategic input. And when a material becomes strategic, markets behave differently. Strategic materials are stockpiled. Strategic materials are secured long-term. Strategic materials are removed from speculative circulation. That alone tightens markets. And as more countries follow China's lead, securing silver for energy, defense, and infrastructure, the pool of freely available silver shrinks even further. This is not a temporary cycle. This is a structural shift. Which brings us to the key question: what happens next? When silver prices move faster than expected, it usually means the market is transitioning from denial to recognition. First comes disbelief, then rationalization, then adjustment, then acceleration. We are now entering the adjustment phase. Manufacturers will revise cost assumptions. Long-term contracts will lock in supply at higher prices. Inventories will be held, not sold. Recycling will increase, but not enough. Mining investment will rise, but slowly. All of this supports higher prices, not explosively overnight, but persistently with volatility. And this is why the phrase breakout matters. A breakout in silver does not mean a straight line upward. It means the old price ceiling no longer holds. It means each pullback finds support at higher levels. It means the market begins pricing silver not as a neglected metal, but as a constrained, essential resource. China's role in this cannot be overstated. By changing how it acquires silver, by treating it as strategic rather than opportunistic, China has forced the rest of the world to reprice risk. And that repricing is happening faster than analysts expected because physical realities move faster than financial models once inventories tighten. The most important takeaway for viewers is this: the silver market did not change because of speculation. It changed because of behavior, because of how the world's largest manufacturer now treats a critical material. And once behavior changes, price eventually follows. This is why silver's recent movement feels different. It is not driven by hype. It is not driven by fear alone. It is driven by necessity. And necessity does not reverse easily. China didn't announce this shift. It didn't need to. The market is responding anyway. Because in commodities, the loudest signals are not words, they are flows. And the flow of silver has changed direction. That is why prices are moving faster than expected. That is why volatility is increasing. That is why the shortage narrative is no longer theoretical. And that is why the silver market entering 2026 will look very different from the one most people thought they understood. The change has already happened, the adjustment is underway, and the price is only beginning to reflect it.